Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, on Wednesday, we saw a fairly decent day across grains and livestock with a pretty good trade overall, despite the quiet holiday, low volume kind of trade that we are seeing here, and we typically see this time of year. Let's say hello and bring in our good friend, Mike Zuzolo with Global Commodity Analytics. He is joining us here today. Mike, good to have you back on the show, sir. Hope you're doing well. Merry Christmas. Happy New Year to you.
Merry Christmas to you, Jesse, and all the great viewers and listeners out there in Market Talk Ag Land.
Well, we appreciate the time, as always, Mike, and plenty for us to discuss and dive into. Just to set us up real quick, Wednesday's trade action. You know, it's that holiday, low volume kind of trade, but yet we found a positive buying day, maybe some technical moves in this market. I know wheat found some good strength on the back of the weather concerns with the cold air, and quart of soybeans had a good day. Livestock had a good day. Overall, just felt like a positive trading session on Wednesday, Mike.
Yeah, third time's a charm when it came to the corn and the wheat being able to finally hold up against some early rally and then midday sell-off. We didn't see that on Wednesday's trade. It was very welcome to see because we had been kind of seen our hopes dashed on Monday and Tuesday, and the market was kind of set up, in my opinion, Jesse, for a third try. And if we didn't have a good time on Wednesday, it could have been a really rough way to close out for the Christmas holiday and the long weekend. But I do think that other than what you brought up, I think the biggest factor that brought on what seemed to be kind of a Santa Claus risk on kind of commodity and asset class wide short covering rally on Wednesday that did hold into the close was maybe the Chinese news that the central government was going to get serious about stimulating growth in 2023. I think that's something the market has been seriously missing and needing to be able to stop selling rallies. And I think that's maybe the best thing I could take away from Wednesday's close. And, you know, right along that same line is we have this mindset now that the Chinese government is serious about stimulating their economy because it's slowing down way too rapidly. But we still do have to walk through the minefield of their COVID surge in China and have to kind of feel our way through whether they can get their economy back running on at least 6 of 8 cylinders with their direct policy moves that they're planning to do here next month. Second thing I'll throw out is the Bank of Japan finally gave up on keeping their interest rates low, keeping their currency weak. And since they changed their mind about 24, 48 hours ago, the Japanese yen's rallied about 5%. That, I think, is starting to bring talk back into the market that not only will money come back into Japan, but it'll come back into the rest of Asia. So you put these two things together, Japan moving aggressively, China moving aggressively, all of a sudden you think, hey, two of the biggest economy and economic engines in Asia are making coordinated moves to stimulate their demand. And that should excite the emerging market bull, should excite the commodity mindset. So kind of want to see where this takes us from here.
I'm glad you brought that up because I had heard the rumors in the trade about China here today and really this week. And I think that's going to be a key component as we look ahead to moving into 2023 is that demand picture for China and more. I'm glad you brought that up because I think you are right. I think the market has been missing that and has been looking for that here for, I'd say, at least the last few weeks, if not longer, Mike.
Yeah, the COVID policy, when they went down to a strict zero COVID policy, and then they went to the dynamic zero COVID policy, and then we had the big Communist Party meeting, those things just dashed the hopes of all the commodity bulls out there, it seemed to me. And I think it's really worth noting, Jesse, I'm not saying that this market has a sharp move higher, maybe in the corn or wheat or soybeans. It could. I'm not saying that yet, but what I am saying is we've done enough damage in the price action, especially when it comes to the wheat and the corn. I just looked up today where we were at the end of December of last year, and we were trading right around 770 in soft red wheat. So not only did we get back to the 770 level in soft red wheat, the December low for this month has been around $7. And so, we're talking about a 70-cent discount compared to where we closed a year ago at the end of the year. And I think that's plenty enough damage and discount and lack of risk premium and pulling out of risk premium to do the job. And so I do think that you have physical demand and investor demand waiting on the sidelines here because of the price action we've seen. Whether you're looking at copper, crude oil, many commodities have gone back down to or below where they finished a year ago at the end of the year.
Mike, I want to talk a little bit about the corn market, and I'll pull up on the video feed a chart you sent me looking at the corn spread. This corn trade, it's been interesting. It feels like, to me, at least, just my thought, it's been working with wheat, and it was good to see it, hold the rallies you mentioned earlier here today. It hold it here and not sell off late. As you look at this corn market entering the final 2 weeks of the year here and heading into 2023, what stands out to you right now?
Yeah, this is lead month corn minus the next contract, so it'd be March minus May. And just from educational standpoint, Jesse, whether you're talking about commodity index funds that really got ramped up in 2005, 2006, and then took a big hit after the financial crisis, and then we saw the hedge funds come in, and it wasn't just about long only funds, but also funds that went long and short. Those two classifications of funds still respect very much, based upon my research and analysis and what I've been able to dig into with how many of them run. They still respect very much the continuation of what the spread looks like between the front end corn and the next contract. And when you have the front end corn, the March contract, in this chart showing us at 1 cent premium to the May, and this was run about midday today. But when you see a premium in the front end, then that starts to signal to many funds that your demand is now outstripping your supply, because they are now back to putting more premium in the front end, wanting to draw out more supply from producers by putting more premium and more cash in the front end market. And so that's an inversion, what we would call an inversion in the funds mindset. That's called a backwardization market. And this is very interesting because I pulled this chart today because I noticed that the cash basis in some of the river areas and also some of the processors were starting to come up. Even though we had bad ethanol data, or negative ethanol data, I should say, I was encouraged for the fact that this market's going inverted again in the corn market, and it's really something to watch, because these are the types of markets that really can start to stimulate some fund buying. And that's why I'm not ready to say the corn can take off, but I'm also not willing to say that this is a dead cat bounce. And one other thing to notice, the last time we were able to see such a move from, say, 20 under, in other words, the March corn just recently was 20 cents cheaper, or it would have been the December corn, 20 cents cheaper than the March. Now all of a sudden the March is a penny over the May. The last time we were able to do that was back in that 2011, 2012 time period. And so that's pretty substantial when you take it from 20 under to 1 over and do that within the same roughly month time period.
I was going to say, I'm glad you brought that up. I look at this chart. Obviously, the eerie similarities to back in 2011, 2012, 2013, Mike, compared to now. I wonder if we can look back at history to give us an idea what we could potentially see continue here as we get into 2023 with this corn market. Just, looking at a chart like this and seeing those similarities, I think it's a question to ponder maybe.
Yeah, it's certainly something to watch. And I think we got to keep in mind, no matter how ugly the wheat price gets, it's still our leader. And if the wheat has indeed bottomed at this point, we still have to go back to the idea that if you take China out of the equation and their stockpile that they may or may not have, but whatever they say they have, that's what USDA puts on their supply demand report. But if you take that off the ledger, Jesse, we're still dealing with the world wheat ending stocks number that's at a 15-year low minus China. And I think this is where the corn. This is where the rice, this is where the oats, many commodities can ping off of the wheat market if we all of a sudden find ourselves in a really tight spot with a lot less supply than we thought we did. And I saw a lot of comments today that the wheat finally bounced because of the cold weather in Kansas. I'm sorry, if that's the case, then these people really don't know how to trade, and they really should just turn in their money and do something else for a living, because we've had this weather and this situation for better than a week. What makes today different than yesterday or the day before? And I think it really is more about the macro situation. That's why these spreads do matter a lot.
Mike Zuzolo, Global Commodity Analytics, is our guest here today. Mike, let's talk the soybean market. I'll pull up another chart on our video feed as well. And I'll look at soybeans, and obviously we've been at this point where we've been bumping up against this overhead resistance, at least here last couple of weeks, at $14.90 range, $15 range. I know that's a talking point. We've made some higher highs, some lower lows, maybe shrinking this, this channel that we've been trading in. So that's some thoughts in my head. But as you look at this soy complex, you look at the cash prices at the Gulf here on this chart that we have, what stands out to you right now?
Yeah, South American weather, I think, is starting to really translate into this chart. And obviously currencies will too. But what I like about this chart so much is that the Argentine bean export price, as shown in the green line, it has developed a substantial premium back up towards its highs for the prices that it had back during the third quarter of 2022. So way back before we even harvested, we're back up to that $625 a ton level. And at the exact same time, that contrasts with a $50 discount in the Brazilian price at $572 a ton, Jesse. And then we're right in the middle of that at the Gulf of Mexico at $600 a ton. What we want to watch for here, and you and I will be looking at this on this chart in the coming weeks on Wednesdays, what we'll want to be watching for is to see if the Brazil price starts to go up towards the Argentine price, because the weather is starting to get worse, and because the rains don't come that the market expects here in the next 10 to 14 days. And that's what I'd be watching for, is that the 572 in Brazil actually starts to come up towards 6 or 6.25. And then all of a sudden you can start to say and suggest to your clients and subscribers, if you're in my line of work, we'll look at the weather premium that the South American price is getting pushed into, and that really bodes well potentially for the U.S. And why is that so important? Well, not only because it's our weather market in South America, and that time period's now, but because China's data this week was dismal. They came in with November imports of soybeans at about 7.4 million tons. I believe I want to say that was down about 14% from last November. And so China really is slowing down, whether you're looking at pork imports or whether you're looking at soy imports, both from the United States and Brazil. They've really slowed down. So it puts more onus on having a supply related problem to justify prices going higher. And this is where the wheat and the corn really do need to come in and help support the soybeans, if you ask me. And if it's a weather market in wheat, like we were talking about a minute ago, it's more about Argentina, because they're about 70% harvested. I don't think it's about the weather market here in the States. I think the trade maybe is coming to grips with the idea that we aren't going to get any more wheat out of the Southern Hemisphere, because Australia is getting wrapped up, Argentina is getting wrapped up, and it's just not going to come from anywhere else.
Good thoughts to consider. One quick thought. You mentioned the weather market potential South America on soybeans. I know China is, their numbers getting dismal, as you mentioned. That export window, that typical export window for beans from the U.S. to China is closing. But I wonder if we have that weather market in South America, does that extend our window just a little bit here in the U.S.?
I do think it will, especially if we can get the Japanese yen and the Chinese currency to both strengthen, and then the Brazilian currency to go ahead and strengthen as well. With all, what we want is all emerging currencies to strengthen against the dollar and just make us have so much better buying power, or I should say selling power, to the world out there through a weaker currency.
Okay, good thoughts there. Let's go over to livestock. Hog market had a really strong day on Wednesday. I know we have quarterly hogs and pigs coming up on Friday. On the cattle side, we have the cattle on feed report. But let's start with hogs. Looking at this chart here on the video feed as well, what are you seeing in this hog market that stands out to you as we near Christmas and the end of the year, Mike?
Yeah, the first thing to look at here is the actual price of the hog index, the CME cash index at $81. That is being propelled lower. And look at the slide we've seen. This is being propelled lower by the Chinese hog meat that is not being purchased and sent over. And we are starting to see, I think, some backlog of domestic production that's coming back into our market. But it's also being projected out through the fact that the pork cutout is not doing well during this time period, and it really should be. In fact, the overall cutout hit 83.50 earlier today, late yesterday. That's the lowest since early December of last year. So that got me thinking about, okay, all of a sudden we've got a CME hog futures rally, very sharp rally today, probably basically on the weather and the winter weather, maybe a little bit on the hogs and pigs question mark, but mainly I think on the weather. And all of a sudden we're driving into the end of the year with a growing premium in futures over the cash index, which I typically don't like. But having said that, if you look where the green arrow is, about a year ago, almost exactly in this same time period, we saw a futures rally, and all of a sudden the cash index followed the futures higher. So I'm not ready to call the alarm bells yet. But if we continue to see weak pork export sales, Jesse, I am going to be more and more nervous that the hogs are not only going to be limited in the futures market and the funds will turn sellers, but that pig meat and that pork will start to backwash into our market more and really start to affect our cattle upside potential as well.
That's a great point, and I know that's something you'll continue to track, and we'll track it with you here as we work through the next couple of weeks and get into that first quarter of 2023. Good stuff here. Mike, cattle, I feel like traders may be looking ahead at that cattle on feed report a little bit, but I also think maybe some spillover from the hog market on Wednesday. What's your thoughts in the cattle side?
Agree wholeheartedly, and I think we're pricing and also some winter problems and marketing, and I've already heard that in the middle part of the country that we've just pretty much shut down at this point because of this Arctic bomb that's coming through, this Arctic cyclone bomb that's coming through. And I think this is where you can keep the market fed as far as the bull fed on weather like this, Jesse, but I think we're also attaining some price levels that we really can't shake our heads or turn away from, because K-State's break-even numbers right now for December using like a 157, 158 price is putting you at about $120 a head profit at this point, and that's really up there, especially as you get closer to $200 a head. That's very rare that you get those kind of levels of profitability over the course of the last 15, 20 years. So I really do want to take some time and get some hedges in place if we can get some more moves higher, and especially if that cattle on feed report disappoints. That at the end of the day, the weather's important, but it's really the cattle on feed report that's going to make or break our trend, I think.
Well, Mike, I know we can't predict the markets looking ahead. We do our best to have an idea, but we obviously can't, completely 100% forecast what's going to happen. But I know looking ahead to 2023, we've had a volatile, wild year in 2022, a lot of different factors. A lot of those same factors probably going to stay in this marketplace moving into 2023. But as we wrap up the year, reflect, look ahead to 2023, what stands out to you is maybe some of the big factors that you're keeping an eye on as we turn that calendar over, Mike?
It's interesting, Jesse, because we really haven't replenished supplies this year like the trade was thinking we would, and yet we've kind of acted like we have. And I think that goes back to that demand negativity that we talked about at the top of the show. And I think that is what we need to, quite frankly, shake that ghost of Christmas past off as we get into Christmas future of 2023. And I think we're right on the cusp of doing that, because why? The two biggest factors that you and I have talked about throughout pretty much all of 2022 is, when does the Fed policy get more neutral? When does the Chinese policy get more pro-growth? And all of a sudden, I think now we find ourselves on the doorstep of those two things. And so I think the key with 2023, and I talked to a really good client north of me today, we were talking about new crop bean sales and how this past couple of years selling early in the year seemed like it was some of the lower prices. But that gets you into trouble if you keep in that mindset that this year's going to be that way as well. I really think 2023 could be a year where you can feed the bull through continued bad weather, but you're really pushing on a string and asking the odds man to be in your favor again. So I think locking in great profit, coming back in and buying selectively to re-own in case there are weather issues, I think that's the way to go in 2023, and don't just immediately cast off some of these prices that we're looking at, whether you're looking at cattle 12% higher right now versus last year at this time, or looking at soybeans, which are dancing on $14 again in new crop.
Well, Mike, I know end of the year, a great time for folks to reach out, get some advice as they're looking at things heading into a new year. I know you have a lot of great research and a lot of tools available for folks there with globalcomresearch.com, your website, and more. And I know that's a great place for folks to start to learn more and potentially work with you, isn't it?
It is. And I think two words that I try and sum up with everything I do, Jesse, is profitability and consistency and recommendations. And so those are the two things that I think about every time I get ready to write copy. And I hope that helps a lot of people out there. So sign up for a trial, check out our product services, and see what kind of line of things that we do probably suit one of your needs.
Global Commodity Analytics, and you can find them online. Global Com Research, Global Com with two M's, globalcomresearch.com. With that, Mike Zuzolo, Merry Christmas, sir. Thank you, as always, for all the great content and analysis, and I know we'll be talking to you again in the new year. Thanks so much, sir.
Jesse, you and the relationship that we have has been a true blessing for me, and I'm so thankful for you and very thankful for all the people out there. So Merry Christmas to you, my friend.
We appreciate it. Thank you, sir. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.